Welcome to the Microcap Brief. Imagine this scenario. A stock you own, one you believe in, is suddenly in freefall. Panic is spreading online. And then you see it, a newly published report from a short seller calling the company a fraud and predicting its collapse. What do you do? Do you sell? Do you buy more? Do you fight back? Today, we are giving you the complete playbook for this exact situation. We will teach you how to see the attack coming and then provide a step-by-step forensic guide to turn their attack into your advantage, helping you determine if they've uncovered a disaster or created the buying opportunity of a lifetime. First, how do you spot the warning signs before the report even drops? Think of it like a weather forecast for your stock. You need to know how to spot the storm clouds gathering. There are two key data points to track, and you can find them for free. Your primary tools for this are financial data websites like Yahoo Finance, MarketWatch, or your brokerage platform. First, go to one of these sites and type in your stock's ticker symbol. On the main quote page, scroll down until you see the short interest data. You are looking for two numbers. The first is short interest. This is the total number of shares that have been sold short. The second number you need is the average volume. Now, some sites show a metric called days to cover, but it's better to know how to calculate it yourself. The formula is simple. You take the short interest and divide it by the average daily volume. For example, if a company has a short interest of 5 million shares and an average volume of 500,000 shares, you divide 5 million by 500,000. That gives you a days to cover of 10. This means it would take 10 full trading days for all the shorts to cover their positions. A single data point doesn't tell you much. You are looking for a dramatic change over time. If that company's days to cover suddenly jumped from under 1 to over 10, that is the spike. That is the financial equivalent of the barometer suddenly dropping before a hurricane. It tells you a large, coordinated bet is being built against the company. Now, it is crucial to understand that this free data is delayed. Regulators only require it to be reported twice a month, so you're always looking at a photograph of where the shorts were a few weeks ago. But it's still an incredibly powerful tool. It allows you to see the footprints of the predators and tells you when to be on high alert. Once the report hits and the stock is under attack, you do not panic. You become a forensic auditor. This is your 4-step playbook. Step 1. Analyze the thesis. Read the short report carefully. What is the core accusation? Are they arguing the stock is simply overvalued? Or are they alleging something more serious, like a fraudulent product or a deceptive business model, as Hindenburg did with Nikola? The nature of the accusation matters. Step 2. Verify the facts. This is the most important step. Treat the short report as a research roadmap and go directly to the primary source, the company's SEC filings. If the report claims the company is burning too much cash, you don't take their word for it. You open the latest 10Q, find the cash flow statement, and calculate the cash burn yourself. If the report mocks the company's billions in pre-orders, you find the S1 filing and see if the company legally described those orders as non-binding. You use their claims to guide your own investigation. Step 3. Evaluate the company's response. A company under attack will always respond. You need to analyze how they respond. Do they issue a detailed point-by-point rebuttal that uses facts and figures from their own financials to disprove the claims? Or do they release a vague, emotional press release that attacks the character of the short seller without addressing the core allegations? A strong company defends itself with facts. A weak one defends itself with outrage. Step 4. Follow the insiders. In the days and weeks after a short attack, go to the SEC's Edgar database and watch the Form 4 filings. Are the CEO, the CFO, and other directors selling their stock into the panic? Though, be aware, some sales may be part of pre-planned trading plans. Or are they stepping up and buying shares on the open market with their own money? A pattern of insider buying during a period of intense negative pressure is one of the most powerful signals of confidence management can possibly send. By the end of this four-step process, you will have moved beyond the fear and emotion of the attack. You will have a clear, fact-based view of the company's real situation. You will know if the short sellers have exposed a fatal flaw or if they have just created an incredible opportunity for the informed investor. Thank you for listening to the Microcap Brief. Do your own research and invest wisely.